Of the opening bell, we've got about 10 seconds to go until the final trading day of the year, and futures are higher, so it does look like we could at least have a positive start to the cash trade this morning after a rough couple of sessions, with the Magnificent Seven falling hard and dragging down the S&P index 2% over the past 2 days. That makes December a bad month, as Sonali pointed out, the worst since April. There you see the opening bell ceremonies on the New York Stock Exchange and on the NASDAQ marketplace. Brings a tear to my eye. Not really.
As a capitalist.
It's been a great year. Why would I cry, right? We've been up 24%.
Exactly.
With reinvested dividends, I think more like 26% year to date for 2 years in a row here. And if you take a look at the cash trades that plays out right now, we're up about 0.3%. And Sonali, for you and me, it's been one for the record books, right? Because we launched our show this year.
We did. I get to spend every morning with Matt Miller.
Oh, lucky you.
It has been a ride.
The short straw.
As long as he doesn't make me start riding Harley Davidsons, the peace will be kept.
You can ride a Vespa with me.
Oh,
that's how I roll.
You know what?
A Vespa on the Jersey Shore.
Maybe that'll change the game for me. I don't know. Vespa
Yeah, it's
instead
big.
of a hog.
Vespa is a great kind of gateway drug to motorcycling because it's got an automatic transmission. It's pretty easy to deal with, and it is, I would say, just as much fun as a big bike. I mean, be honest, awesome. Paul. How great is it for your mental health to get out there on the Vespa?
It's fantastic, and especially down at the shore. You know, in the summertime, cruising up and down. It's excellent. And you know, when people raise their hands and say, "What do you ride?" I'm like, I ride a Vespa, of course.
Yeah,
I know what's going on.
2025 resolutions, but of course, good moods here. We're ending on a higher note.
Well, we're starting to end on a high note. I remind you that things can change throughout the day. It's been we've had some volatile sessions over the past couple of months. Isabel Lee is here with us in the studio to give us a breakdown of what's going on just in the opening few minutes of trading. Isabel, what are you looking at?
I'm looking at Verizon. It opened in the red and now it's up, but it's really flat. It's up just 0.9%. So the company was hit with a proposed class action by retirees who say that Verizon improperly shifted pension benefit responsibilities to, quote, risky insurance companies. So this includes Prudential and RGA. So former employees allege that the company breached its fiduciary duties and jeopardized the retirement savings. So the lawsuit is the latest to take aim at what is called pension de-risking transactions. It basically means a sponsor of a defined benefit pension plan lessens the risk it faces in connection with a sponsoring plan. So suits over the issue have boomed in the past year, and the complaint also takes aim at State Street. The filing says it's a plan fiduciary but acted in its own financial interest. So Sonali earlier said that this has been booming the past year, and they talk a lot about it in their show, and it's an interesting allegation because if proven, it's probably a big thing.
And probably will mean more lawsuits at different companies.
Well, I'm just looking at Verizon. Stock's up 5%. I mean, knowing this company as well as they do, being a customer forever, I just don't know what the growth drivers are. I mean, you got landlines in a secular decline. You got wireless competition everywhere you look. Broadband competition everywhere you look. That's a tough business. I guess you own it for the dividend. I don't know.
The lawsuit also reflects what we've been seeing in a lot of corporate America as well. This is around the benefits you get after you retire.
Yeah.
And so company after company, I know Matt is always asking why a pension still exists, but certain people definitely still need one.
Oh, I would love. I need a pension. It's not about need, right? It would be fantastic.
Is it the model that works? That is the question.
Well, Verizon, I mean, these are the legacy regional Bell operating telephone companies back in the day, which you did get a pension, and that was part of the gig. So,
but now that they've transferred into other financial companies, they can't manage it on their own.
No,
or don't want to, rather.
No, you got to get rid of that.
Isabel, what else are you looking at?
MicroStrategy is kind of flat, but it recently bought again 209 million worth of Bitcoin. It's 8th straight week of buying. Who knows if this will continue next year, but it's really interesting. And this week's buying is the fewest in this entire stretch. In November 25, it bought as much as 55,000, bringing their total to $45 billion worth of Bitcoin. Essentially, it's what people call now as a Bitcoin company, Bitcoin proxy hedge fund. And honestly, it's been working for MicroStrategy. Just last week, it was added to the NASDAQ 100, which some criticism, but still, it is a big milestone. And the next maybe will be the S&P 500, although that's a different discussion altogether. But really, it's been a spectacular run for MicroStrategy. Its market cap hit 100 billion, or it's flirting with 100 billion.
Bitcoin up 4.5% today,
Yes.
96,000 on Bitcoin. Remember, we hit a high about 2 weeks ago of
Will we hit
107,000.
100 back on Bitcoin before the end of the year? Will we hit 6,000 on the S&P again
We're
before the end
getting
of the
there.
year?
It's unlikely, right, in the next few hours. Although with Bitcoin, you never know, right? We have seen that kind of volatility in the past.
Yes.
To me, it's insane
Maybe
that
a
this...
big market buyer comes back at the end of the
Tom
close.
Keene has been making fun of me for at least a decade.
Yes.
Because of my interest in Bitcoin. But when he started, it was
Yeah.
trading for less than $1,000 a pop.
Exactly, and as he refers to it as BitDog, and we try to correct him on that, but he's holding steady. He's one of those skeptics. He's got a lot of company. Jamie Dimon among the skeptics.
True. Saying at one point, I think that Bitcoin was worthless. Warren Buffett also.
But why don't you just, here's the way to think about it. It's totally inoffensive to everybody. It's just a commodity.
Right.
Think about it as a commodity. Nothing more. It's not an asset. It's not a currency. It's a commodity like anything else in the world, supply and demand. If you have an opinion on supply and demand, you've got an opinion on Bitcoin. That's the way I think
hear
about it.
opinions also on NVIDIA as well, because you're looking at a day where one of the best performing stocks in the market, I say one of the best performing because, of course, there were actually some firms that rose more, trying to get into the green today, but not quite making it.
We have news today that it completed the acquisition of Front AI. That's an Israeli startup founded in 2018. It helps basically manage AI hardware infrastructure. So news of this first broke in April. So the news today is the fact that it completed the acquisition. So the software currently works only with NVIDIA-based systems, but it will be open source, meaning rivals of NVIDIA like AMD and Intel can adapt this software to their hardware. So NVIDIA declined to comment on the value of the deal, but we have an Israeli newspaper reporting in April that the value is around 700 million. So an interesting point is Israel is NVIDIA's second most important market, and NVIDIA's last major deal in Israel was $7 billion, which is the acquisition of Mellanox. But still, NVIDIA's dominance is still unrivaled, and it really is exciting what will remain in store for the company next year. It's up almost 400% this year.
Yeah. So the year-to-date NVIDIA, just extraordinary here, $3.36 trillion in market cap, up 176% year-to-date. And as Joe Weisenthal so sagely pointed out in his tweet, the year-to-date numbers on the Bloomberg terminal are actually the same as the one-year return. How about that?
You know, it's really
I
interesting.
mean, only Joe Weisenthal could come up with that.
Isabel, thank you so much for all of your coverage. Of course, that's Isabel Lee of Bloomberg News. You know, more on NVIDIA here, because what's interesting is in addition to the 177% increase you've seen in NVIDIA, Broadcom right behind it.
True.
It is now up about 110% this year. Coherent had an interesting run, 117% as well. That broadening of the AI trade might be the broadening a lot of investors hang on to.
Did
That's
you
a great
see
point.
also, producer Samantha Danziger sent out a story that I think the top 500 richest people in the world are worth $10 trillion. And so I pulled up Rich Go
Yep.
on the Bloomberg terminal. I see Jensen Huang at number 12,
Yep.
right? He's now worth, the CEO of NVIDIA, $120 billion. His worth has climbed $76 billion this year, which, I mean, isn't shocking, but it's just
Did you
remarkable.
say they're worth 10 trillion?
They're worth 10 trillion in total. I mean, look, Elon Musk is worth almost $500 billion by himself. He's worth 442.
10 trillion is more than 3 times the GDP of France.
There you
Yeah,
go.
it's worth. They're worth a lot of money. That's we're talking about 500 people. I also saw at the top of Rich Go, the Waltons have increased their wealth amazingly.
Yep.
Jim Walton worth 112 billion, 40 billion more than he was at the end of last year. Rob Walton worth 110 billion, 40 billion more than he was last year. Alice Walton worth 110 billion, 40 billion more than she was worth last year. These are their individual net worths, not as a family.
And Alice Walton sports a unbelievable yacht, by the way, so go Google that. Pretty darn cool. Steve Sosnick joins us here. He is not on the list. I'm sorry, Steve, on the Rich Go
None of us
list, but you're working hard at it. Appreciate it. Steve Sosnick, Interactive Brokers Chief Strategist here. Steve, what are you telling your clients these days about 2025? Because, boy, expectations, I'm guessing, is 20% plus gains each of the last 2 years. Expectations may be getting a little out of whack here. How do you temper those?
The way I temper it, Paul, and good morning, is basically just, it's a tough tape to fight, although it's getting a little easier, quite frankly, in the last few days, but because I think we're seeing some asset allocation trades that have sort of hit the thinner markets. And, the mantra's been, don't necessarily fight the tape, but insure against it, because I do think that everybody's on one side of the boat right now. Even people who are not necessarily raging bulls will say, yeah, we're looking for 10% up next year. And, historically, that's a big hill to climb. And so I do think you have a lot of volatility events coming down the pipe. If you look at VIX for the first 6 months of the year versus the second 6 months of the year, it tells a very different picture, where it did nothing for the first 6 months. And lately it's been moving around. So there's volatility creeping back in. I think one of the things, if you're buying dips, and a lot of people have made a lot of money buying dips, VIX and volatility is one of those things you buy the dips in.
Fascinating. What about the dips in the bond market here? If you think about the stock market volatility, the bond market volatility has been more aggressive in a lot of ways. Is that signaling more pain to come when you think about how volatile broader markets can be next year?
It depends why we've seen this rise in rates, Janali. If it's because everybody's decided that the economy is going to be rip-roaring ahead, well, then that's a good reason for bonds to rally. I'm not so convinced that that's the case, because real interest rates have risen alongside of nominal rates. So I think it's just more demand for return on that money, and that does signal a bit of risk. And one of the things I like to remind people is the biggest thing that the U.S. exports is actually our debt. And the amount that foreigners buy our debt is bigger than the amount of foreigners buy of any single thing we sell in the U.S. And so there's worries about capacity. There's also concerns. I happened to do a podcast blindly with Stephen Miran earlier this year, and he, his thesis was, it was him and Nouriel Roubini. That was quite a room, and they were basically, they had written a paper saying that the way the Treasury's bond issuance was going by prioritizing the short end was artificially depressing rates. Well, if he's now going to be the head of the Council of Economic Advisors, and he's got Scott Bessent's ear at Treasury, that actually might push out some more supply into the long end, and that's possibly why we're seeing long rates doing what they're doing, and also probably why we're seeing what I think is pension funds selling appreciated stocks and buying depreciated bonds to rebalance their portfolios.
Fascinating.
By the way, part of the reason also that we now spend over $100 billion a month servicing our debt.
Makes my nose bleed.
Maybe they should have sold some more long end debt when we were at zero rates. And Steve, let me ask you about the Treasury, the levels that we're looking at right now, 450 and change. Is that going to be a problem for a 2025 rally? I mean, the fact that we've gone up so far so fast, we've priced in all the good stuff we expect from the Trump administration, and we're running up against, there's a pivot in the Fed easing, path, and now we're looking at 450 on the 10-year.
Well, right, Matt, this was supposed to be the line in the sand, and we kind of blew right through it to 465-ish or so without much concern. If we were all investing like truly rational value investors all the time, we would be saying, well, yes, the higher long-term interest rates means that the present value of the cash flows that we're buying from companies is less, and therefore that depreciates the value of the market. In reality, we're all momentum traders. Whether you like it or not, everybody's basically, for the same reason, we're going to be up another X% next year. It's a lot of momentum. It's also why it's a difficult tape to fight. And so, one of the lessons I take away was 1987, the bond market basically collapsed in 1987 as stocks rallied. So it depends why. If people are moving out of stocks into stocks from bonds, it could persist for a while. If it's really just pure valuation, yes, it should weigh on stocks at some point. It always does. It's just a question of when.
Steve, we thank you so much for joining us here. That's Steve Sashnik of Interactive Brokers. And
Happy New Year.
Happy New Year.
And thank you so much for your support this year. As we've launched this new show, I love to get a message, an IB from you when I'm in the middle of the program.
Yeah, we appreciate it. We all, it's a good note to say also, we love getting IBs in the program. Please communicate with us.
Thank you.
But also, as we've been sitting here, NASDAQ 100 turned red. It's down now 0.1%. The S&P 500 is trying to hold on to its gains, but they are pretty meager. Right now, they're fluctuating between flat and 0.1%. Let's see if it holds. We're below that emotional 6,000 level. Up next, we're going to talk hedge funds. Ken Griffin had said the multi-strategy boom is over, but there's still some big gains there. We'll take a look at it. This is Bloomberg. Welcome back to Bloomberg Television and Radio Audiences. I'm Shonali Bassick alongside Paul Sweeney and Matt Miller, and we are having some fun on the last day of the year because we are trying to see these markets wipe right back into the green. They're up about 0.2% higher on the day, it looks like, for the S&P 500, but the NASDAQ 100, not so much. It's looking still in the red. We'll keep an eye on these markets for you. I am stunned. We haven't really talked about it, but just want to point out, if you've looked at what the 10-year has done over the past couple of days, you're looking at a 10 basis point move lower since Friday. So yes, we're still above that 450 danger zone. 4.5% looks like where we're going to end the year roughly, but we were at 4.6%. A lot of investors, I know.
So I'm not, but can I refinance the mortgage? No, not yet.
No, dude, this is the point. We've gone, look, forget about 460, right? Everyone with whom we've spoken over the past couple of months has said if we get above 450, we're in trouble. And we're above 450. So it doesn't matter that we've come back down from 460, right?
No, but what I'm watching for is if we head to 4.7, if we head to 5%. We just had somebody talk about 5.2%. And yeah, in that scenario, you have to ask not only if you can refinance your mortgage, Paul, you have to ask if this is the only type of rate you're going to get the next couple of years.
Yeah, I think that's...
because we're staying higher.
Yeah, we spoke earlier today with some mortgage folks who said, you know, kind of 6%, kind of the new 3% now. People are kind of getting used to it. And even if you get to the low sixes and 30-year fixed, they think they're going to see some activity, people. Because they kind of gotten real.
You could have had it worse. You could have been borrowing in the 70s, but no. Historically, we're still low, but
or
it
the
feels
80s,
bad.
right? When rates were like 14, 15, 16%.
Yeah.
Feels bad for somebody who is a millennial or a Gen Z. Anyways, we are going to move on. We're going to talk about hedge funds. It's been a fascinating year. We're going to bring in Bloomberg's Hema Parmar because there was a story, a huge one, guys. Earlier this year, Ken Griffin spoke to our colleague Nishant Kumar, said the multi-strategy hedge fund boom has come and gone. But Hema, we are watching some defy the odds still.
Yes, you're seeing really a lot of still hot demand for these multi-strategy funds. You're seeing multi-billion-dollar launches. You're seeing a talent war that is persisting in the space, and you're seeing decent returns. So even though, yes, the amount of money that multi-strat funds oversee now has dipped down, in large part that's because some of these hedge funds return money because they're capacity constrained, but you are still seeing really hot demand from investors to want to invest in these funds.
What I see, though, is like back in the day, 90s, the 2000s, you had a good trader from Morgan Stanley or Goldman Sachs had 2 or 3 good years, put up a book. They could go out and raise $500 million or $1 billion in their strategy, whatever it was, and then have a nice life.
Yeah.
It doesn't seem like that happens that often anymore. It seems like a lot of the new money or incremental money coming into hedge funds is going to the really big shops like the Citadels, like the .72s, like the Millennium. Is that kind of how this market is these days?
So it is harder to raise a fund, and a lot of the money is going to the established funds. But, you know, in the past year, we have seen some really sizable launches. We've seen Bobby Jane raise $5.3 billion this year.
He wanted
Diego
more, though.
Meggia. He wanted much more. He was aiming for initially 10.
Yeah.
But still 5 is a lot. It's the second biggest launch, basically, of, you know, what we've seen maybe ever. Diego Meggia raised $5 billion. Freestone Grove, $3.5 billion. You know, there was a lull for a few years where we didn't see a lot of big launches. Maybe the last year of significant size launches was 2019-ish. And so seeing this size of capital coming into these funds, not to mention when you look at Millennium, speaking of capital going into existing funds, they opened their doors recently and they were seeking $10 billion. They had demand for $20 billion. That shows the capital that they had to turn away.
Well, interestingly enough, too, we had Diego Meggia's firm raise money also from his prior firm, Millennium. Correct me if I'm wrong, I don't believe we saw that for Freestone Grove. Freestone Grove, no. Todd Barker and his co-founder were Citadel executives. So you're seeing kind of, we call them Ken's Cubs. Mm-hmm. They're kind of spinning off of Citadel and creating these new firms, same with Millennium. But, you know, when you think about how large those rivals are, can they really compete at the end of the day?
how
the new firms
the new
versus
firms compete.
the Millenniums and Citadels of the world. I think Ken Griffin's comment here was kind of a warning shot across the bow that once you're Citadel or Millennium, you're kind of the king of the castle here.
Yes.
You can't get bigger than that, and you're going to steal the show no matter what over the next couple of years.
Yes, and the question is whether when you're launching a fund, are you looking to take on the Millenniums and the Citadels? Some of these strategies, like Freestone Grove, is actually trying to be the anti-pod shop, and they're more specific in the way they're targeting the space. Jane Global does seem to be trying to compete a bit more with the Millenniums and the Citadels because of the strategy. But what's interesting is you do see a trend. You know, when you look at these funds being capacity constrained, not being able to take on additional money because it could impact returns, we're seeing these funds do really unique things to embrace more capital and do what they can with it. So you're seeing Millennium, for example, investing in other hedge funds a lot more often. So they'll take investor capital and invest in outside firms. You're seeing some of these funds consider private investments, which is not something they've done before. And you're seeing them bulk up their talent inside their firms to push into new strategies. Point72, we typically thought of them as a long-short equity shop. They've been pushing rampantly into macro over the past few years.
Why are these all dudes? Like, is this still just a big boys club? I haven't heard you mention one female name, and you've talked about like 20 people.
Yeah, it is still largely a male club, but we have seen some recent ones. It is still largely, yes, it's definitely male dominated.
So who are the women that we should be paying attention to in this space?
Yeah, so Mala Goankar, she's
been around a while.
She's been around for a long time. She was very senior at Lone Pine.
Yep.
She raised a fund, launched in last year or the year before with about $1.8 billion, the biggest female-led launch we've ever seen. Divya Natimi, ex-Viking Global, she raised a fund also above $1 billion. So we are seeing more and more rising female stars in the space. We would love to see more.
It just seems important to me because, I don't want to get any backlash. I know ESG is dead and over. You know, God rest its soul. But some people might want a different perspective. You know, you may want a female perspective, and that could be a reason that you go with a smaller fund, a newer fund, over, you know, Izzy Englander or Ken Griffin.
There was a time where CalPERS and a lot of different large pension funds had a bigger effort to give money to female-led hedge funds. By and large, those efforts have really wavered. And so even from the allocator's perspective, you've seen kind of a lot of shrinking of that. Plus, actually the opposite has happened. People are giving money to those bigger and bigger managers. You covered, what was it? Tried to raise $5 billion, ended up raising much, much more. Was it Millennium opened up to money again this year?
When they raised, they were seeking 10 and they had 20 billion in demand.
Exactly.
Yes.
It's more money than you can imagine going to the bigger managers.
That's exactly the trend.
Yeah,
and so what it does not give you, and this is I have a negative bias against hedge funds. I think the risk-adjusted returns are inferior. That's just my personal opinion. I've held it since 2005.
When
I did raise a fund in 2005, we raised $500 million, but it was not sticky money, unfortunately. I just think they're all going, a lot of the money's going to the really, really big firms. Therefore, it feels just more institutional to me. It feels less entrepreneurial. It feels like less opportunity for alpha. And what I'm paying for is, I'm not paying for beta, I'm paying for alpha.
Are you paying for diversification?
Well, now you're not getting it, I think, because these funds are so big now.
Well, you know, it's been one of the most tricky fundraising environments that we've had in years, over the past few years. It is harder to raise a fund if you are a new launch, especially if you don't have the tenure, if you don't have the experience. On your institutionalization point, yes, the big money comes from these institutional investors, but we have also been seeing a retailization of the hedge fund space, as we've been seeing in private equity, in real estate. And you're seeing more and more of these bank platforms really trying to get their ultra high net worth individuals into some of these vehicles, and there's pros and there's cons to both of these efforts, but it's a really interesting shift that we've been seeing gaining momentum and velocity in the past year or so.
Scott Bessent filing for an ETF before he ended up getting the Treasury nomination. The retailization is fascinating, but to your point, Paul, you have to be wondering whether they're really transporting that alpha.
Yeah, it's interesting to see, but they continue, as you have your reporting points out, continue to attract tremendous capital, and through cycles as well. So,
Emma, what you got going on tonight?
New Year's Eve plans, having a party tonight, going to a party tonight, so it'll be fun.
We have one
What about you
partier,
guys?
finally.
I'm going to a party.
What are you doing?
I'm going to a party tonight. I'm actually going to venture out into the realms, the far off lands of Brooklyn.
You're
Yeah.
doing it. All right.
I'm going to
was skeptical
Dumbo,
yesterday.
which is that under the bridge or
Down under the Manhattan, Brooklyn
There you go.
overpass.
I like
there you
it.
go.
I like it. All right, Hema Parmar, it's been awesome spending 2024 with you on our program. I look forward to more reporting from you in 2025. Matt Miller here with Shonali Bassick and Paul Sweeney in the Interactive Brokers Studio. Happy New Year. We come back, we're going to talk to Veronica Clark from Citigroup. She's the Director of Research there and U.S. Economics. This is Bloomberg. Happy New Year's Eve. Matt Miller here in the Interactive Broker Studio with Sonali Bassick and Paul Sweeney. We've crashed his show. We're simulcasting on television, radio, and YouTube.com. Is the comment section open?
Of
The
course.
comments?
Yeah,
The
Always is.
comment
live
section?
chat. Tom's all over the live chat.
Yeah, well, but Tom's on vacation. He's sipping a martini in Paris somewhere.
Yep.
And we're looking at some gains to finish the year. At least right now in the cash trade, S&P 500 up 0.3% at 59.24. So it doesn't look like Sonali we're going to hit 6,000 again before year end.
It's kind of crazy because that was the moment that everyone was so excited about, but you know, analysts had upped their revisions all through the end of the year, 62,000 to or more sometimes. Remember the exuberance in November?
Yep.
We did not even hit that.
6,500, 6,750. We heard a lot of higher forecasts. You know, we're still hovering around 6,000, which is a 25% gain plus year to date after a 25% gain last year.
And you think about the forecast coming from Wall Street, they're looking for kind of high single-digit returns in the S&P 500, but the estimates, earnings estimates, are double-digit. So the implication is a lower multiple there for this marketplace. So we'll see how that plays out.
And of the estimates, Lou Wang, I think, for Bloomberg News, compiles these strategist estimates for us all the time. I always bio her ticker and then look up what she's got, the latest. None of the 19 chief strategists at the major banks that she surveys expect the market to drop next year. There are zero bears out there.
Not just about that, right? Part of this is, okay, where can you find returns that are better than the S&P next year? If you believe that the S&P is only going to rise single digits.
Why want to do better? Oh, yeah, okay. If it's only single digits, maybe you can outperform with treasuries. I mean...
Well, to that point, too, with treasuries without the risk.
Yeah.
Right? People held out in cash this year did even better than they did most of the treasury market.
Treasuries barely eked out a gain. Paul and I love that INGO function on the Bloomberg terminal, and you can look at the global ag did better. I think it's up 3.5%, but U.S. Treasuries are up just like 0.6%. Oil down year to date again. Brent crude, the global benchmark, off I think 3% and change year to date, off 10% the year before that. So you know it's not good for everybody. But gold, the dollar, most of the assets that we follow and talk about a lot have been on an absolute tear. As a result, people have gotten far wealthier. The rich have gotten richer this year to an amazing extent. In fact, as we were talking about earlier, the world's 500 richest people reached a combined net worth of $10 trillion in 2024.
That is solid. I mean, all of that is in the stock market. And if you look at Elon Musk is just far and above the wealthiest person on the planet. And now he's encamped down at Mar-a-Lago. So we'll see how he spends his 2025. But I mean, you take a look at the absolute change in net worth for the year for Elon Musk, $213 billion increase in net worth.
His net worth doubled.
Exactly.
And not only that, there's a $237 billion gap between him and Jeff Bezos. That was on December 17th, was the largest ever gap that was ever recorded between the first and second ranked names on the Bloomberg Billionaires Index since its inception. So that is not only how wealthy Elon Musk has gotten, but even how wealthy he's gotten relative to all the other billionaires out there.
Yeah, he's worth basically the number one richest person in the world is worth the number two plus the number three. Let's get over to Isabel Lee. She's got details on RichGo for us. Isabel, that's the function you type in RICHGO on the Bloomberg terminal, and it gives you a wealth of information.
Yeah, so this story is either a feel-good story or not. You can do with it what you will, but it's really a spectacular year, especially for the world's richest. And Elon Musk is the one who dominated the world's wealthiest, to everyone's point. And it's really his close relationship with Donald Trump. And yes, he has encamped himself in Mar-a-Lago. I think it's $2,000 a night in that hotel, according to a news article I just wrote. It depends on whether Donald Trump will make him pay or what, but $2,000 a night is nothing to his fortune.
He has paid already, right? We were talking about this yesterday. He's paid like $250 million in backing Trump's campaign.
Yes, but his stay right now, he's still there, $2,000.
If you donate $250 million, if you donate a quarter of $1 billion to my campaign, you can stay at my house for free.
And then it's really his companies, Tesla, SpaceX, XAI, and you're right. He donated $250 million, and everyone's saying this is the best investment ever because the ROI is limitless. Who knows what will be? Who knows whether policy will be amended to benefit his company? It's really interesting. And of course, we have the stock market tiding the wave over all the riches. And of course, we have Donald Trump's victory. I mean, it sparked a historic rally ever since he won. We saw that the Bloomberg's Billionaire Index represented a gain of $500 billion in the 5 weeks following the election. So the Trump bump is big and real.
Taxes, yeah. You know, one of the few of the top 10, top 20 richest people in the world that saw a decline this year was Bernard Arnault, LVMH. He clocks in at number 5 richest person, $175 billion, but that's down almost $32 billion this year as luxury has run into some problems. And we're going to speak later this half hour. Deb Aiken, she covers the luxury business for Bloomberg Intelligence.
Actually, French billionaires in the world took their biggest hit ever. It's not just Bernard Arnault. It was Francois Pinault. It was Francois Bettencourt Myers, who was once the richest, I believe. Yes, she was the first woman to have a fortune of $100 billion and now has lost the crown as the world's richest woman. So troubles in luxury that we'll talk about a little bit more later.
And you can connect this with the Chinese economy because Chinese shoppers have slowed their spending on this, and they're really one of the biggest buyers of luxury brands. And I saw an Instagram post saying that luxury is out for 2025 because, I mean, who among your friends still buy luxury items? I'm sure some, but really it's quiet luxury these days. So they say, who knows what will happen in 2025. But
well, I mean, you know, all the luxury brands, you talk to all the analysts that cover luxury, they say the Chinese consumer is that marginal consumer for luxury.
I think it's a really important point you made earlier. Is this a good story or a bad story? Because you did see that K-shaped recovery continue on in the United States, and low-income consumers still feel the brunt of inflation, while the rich did get much, much, much richer.
Yeah, I don't think there's anything inherently bad about rich people getting richer. The problem is that the
disparity.
The disparity has grown, continues to grow. We recognized this as a huge problem over a decade ago, and it continues to get worse and worse. And I think poor people need to realize you've got to kiss the ring. Go to Mar-a-Lago, donate $1 million, retract an editorial, make sure the Donald knows that you're on his side.
Not everyone has $2,000 a night to spend and a $1 million membership to pay.
I was being sarcastic.
As we were talking about, more than 85% of the country still earns $100,000 or less, and that segment of the economy is the one that's struggling the most.
Yep. If you don't own real assets, whether it's stocks, bonds, or real estate, the inflation bug was very difficult to deal with, and that's kind of what we're seeing. So, Isabel, thank you so much. We appreciate that. Isabel Lee, Bloomberg News, kind of giving us the latest on what we're seeing out there in the marketplace. Kind of mixed right here. The S&P up about 5 points here. Veronica Clark joins us. She's a director of research and the U.S. economist over there at that little bank on the corner called Citibank. Veronica, what's your 2025 message to your Citi clients about this U.S. economy?
Yeah, I liked the previous discussion of the very bifurcated economy I think that we're experiencing, where lower income people are certainly struggling, higher income consumers are maybe what is supporting aggregate consumption. But I do think this is a very precarious economy, and that's I think the message for 2025. For our view, it really does come down I think to weakness that we're seeing in the labor market, and I do worry that the Fed has maybe gotten a bit complacent on that labor market weakening, and we do think that this is a Fed that's going to be cutting rates a lot more than markets currently priced in 2025.
The Fed is going to cut rates more than is currently priced in 2025. So you're not worried about policy-driven reinflation next year?
Yeah, not particularly. I think a lot of the fundamental drivers that we've seen of inflation over the last couple of years do look a lot better, even compared to a year ago. Even just this morning, we got Case-Shiller home price data. Home prices are running at a normal pre-pandemic kind of pace. That doesn't seem like a future source of inflation, and that's really where you would see signs of reemerging inflation if rates were too low. We do see the labor market weakening. That means that wage growth has slowed. The labor market doesn't seem like a source of inflationary pressure anymore. I do think there's a lot of ways that we can see something that looks more like 2% inflation in 2025.
So one thing I wonder about a lot too is you saw that bifurcation in the economy, and you're kind of already hinting at potential further pains ahead. There was a great point made earlier today by Danielle DiMartino Booth that you might see some of those kind of middle to upper income consumers also start feeling some pain. Some of that pain might be seen as early as the coming days when you look at kind of student loan repayment rates, for example. Housing prices are still high. Cost of rent is still high. I mean, how do you think about that drift higher in terms of the pain that consumers will be feeling into 2025?
Yeah, I do think that's what we've seen, very gradually happening over the last year or so. A lot of aggregate, measures of consumer health really don't look, very comforting. We have the savings rate, which is below pre-pandemic levels and falling. Consumer delinquencies on credit cards, auto loans, they're above 2019 levels. Yes, student loans haven't been counted as defaulted yet, but they will start to be soon. Those do have to start being repaid. I do think the fundamental driver of whether people are going to continue spending is if you have a job or not. And of course, the unemployment rate is still at a healthy level, but it's been trending higher, and hiring has been very weak. If we do get to that stage where people are starting to lose their jobs, that I think really would get people to cut back on spending.
What do you think drives that? I mean, what pushes companies to, I guess, if there's no GDP growth, they're not going to need to keep hiring. If there is lower revenue for these big corporations, they won't need more people.
Yeah, I mean, yeah, absolutely. We've had 2 to 3% GDP growth for a couple of years, and still the unemployment rate has risen by almost a percentage point from the lows. Hiring is very weak; it's at mid 2008 kind of rates. So we already see that businesses are trying to cut labor costs, and I do think that's a result of maybe trying to offset high borrowing costs. Rates are still restrictive. If people do start to cut back on spending anymore, if that's less business revenue, and you've already been looking for every way to cut labor costs by not hiring or reducing hours, that might get you to layoffs. We've also seen people are not quitting as much, probably for worry of finding a new job. That might mean that lack of voluntary separations might turn into involuntary separations. So there are definitely ways that you can get to that layoff stage.
Given that backdrop, Veronica, how much do you think the Fed could cut? How many times in 2025?
We think 125 basis points. So that's 5 25 basis point cuts. Of course, that's much more than what the market is pricing right now.
So how much then are you worried about the spillover effects? Because we've had investors tell us that, okay, a lot of the assumptions when it comes to stock market projections for next year are really predicated on sufficient growth. But between what you're saying about potential weaknesses in consumers and also what you might expect from the Trump government in terms of efficiency seeking and bond vigilantes just coming after the bond market potentially if the fiscal situation does not improve. All of this put together, does it signal that growth is potentially compromised?
Yeah, I think it does. I mean, we're expecting something like 1% average growth for next year. I do think, fundamentally, if we look back at the last couple of years, I do think rates are restrictive. We've had such substantial fiscal support post-pandemic, and that was the immediate post-pandemic, policies, but also Inflation Reduction Act and infrastructure, and that is going to be fading, in 2025. We'll see if we do get further cuts to government spending, but that fiscal impulse is flat to maybe negative for next year, and rates are still restrictive. This could be the time that it finally catches up with us.
Well, if they cut down 125 basis points, we're at 3% even on the lower bound, and that should be I would say pretty stimulative. Veronica, thanks so much for joining us. Veronica Clark there is the Citi Director of Research and U.S. economist talking to us about her expectations for 2025. Happy New Year to all of you. We're going to talk about how it could get much happier with luxury goods. This is Bloomberg.
All right, Matt Miller, Sonali Basak, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, simulcasting on television. That's a special edition of broadcast about Bloomberg Markets. So how about that? We're also doing the YouTube thing, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us here. Looking at the markets, we kind of turned a little bit mixed here. We got the S&P up 7, and the Dow up 125 points, but Nasdaq's off about 13 points. So a little bit of mixed trading volume is light today, as you would expect. A 10-year Treasury kind of steady, 4.52%. WTI crude oil steady as well, $71.50 a barrel. Bitcoin moving higher, up 3.6%, Matt. We're up at 95,200. And remember, we were just at 107,000 just a couple of weeks ago. I don't know what that was all. Maybe kind of the Trump trade a little bit at that time. So we'll keep an eye on that, though.
We'll keep an eye on that, and it's interesting. I just looked real quick into the Mag 7 price return just for today, and you're seeing that barely breaking into the red as well. Actually, red right now, barely breaking into the green, fluctuating. So some of that risk appetite is still off the table. You see it in Bitcoin, you see it in the NASDAQ, and you see it in the Mag 7.
Yep, absolutely. We'll keep an eye on. There's a ticker for that, the Mag 7.
There is?
On the Bloomberg terminal. Sure.
BM7P index.
See?
That is what I look at it as, a Bloomberg Magnificent 7 price return index. You're seeing 5 of the stocks higher on the day, but 2 are lower, and that is NVIDIA down by 0.9%, and Apple down another 0.2%, but Tesla still in the green, 0.2%.
There is a Mag 7 ETF as well.
Yeah,
I always
there is.
forget the ticker.
And I think there's a leverage one, too, like 2x or 3x. I mean,
Good.
I know. So you want...
Why not?
You want risk? Take more risk.
Load it up.
Load it up. All right, let's talk a little luxury right here. And one of the best voices we have is right here in-house at Bloomberg Intelligence. Deborah Aitken joined us. She's a luxury analyst for Bloomberg Intelligence. She's based in London. Deb, thanks so much for joining us here. We were just looking at Rich Go, and some of the really wealthy people on the planet happen to be some French folks who own some of these luxury brands. It's been a tough year for those stocks. Just step back, and what happened to luxury in 2024? What was the narrative?
I think if we step back to the beginning of the year, January, February, we had some of those, the biggest company CEOs focusing on a normalized year of growth. Now, that followed 3 real years of recovery, 21, 22, and 23. So normalized growth was set, we thought, at around 4 to 6%. It started out okay in the first half, and we were looking for the second half to pick up somewhat on the back of that, and that's where the disappointment has been. So second half 2024, a real disappointment because of so much going on economically, politically, but with a big drag in China and travel retail not yet recovering. And also just the fact that we kind of got to peak price, 25% price increases over a 3-year period on average across the sector to pass on some of those inflationary costs. It all just became too much, especially at entry level.
So what's been the problem? Is it just the Chinese economy and the Chinese consumer is so important to this segment? Because as we look at, rich people, Deb, at least the top 500 in the world continue to get richer and richer and richer. So I can't imagine there's any kind of upper limit on Birkin bags.
Yeah. If we look at the companies that have outperformed Hermes and the types of product that they offer to the market, the waiting list there is still in place. Other high-end names like Brunello Cucinelli, these companies are focused 8 to 10% growth year in, year out, and they're achieving that. But really, it's been twofold. If we think about the China market, just to put it back into context, Chinese consumers, when they traveled 2019, as well as spent at home on the mainland, Macau, Hong Kong, and others, were around a third of the luxury market. And we think they're nearer 23% or so at the moment. So we've basically lost 10% of the market from there. What has happened, though, is that the US has been particularly robust and has picked up some of that. Europe has picked up a little bit, and also rest of the world and other parts of Asia. So when we look at an LVMH's absolute revenue, 2019 versus 2024, even taking out the Tiffany acquisition in 21, its sales are still over 50% higher than they were 2019 in absolute euro terms. But there's been a big shift, and we think that will continue 2025.
You know, another question I have is how much of this is the macro? Of course, China is a massive story. Perhaps we'll talk about it a little more as well. But another thing I'm fascinated by is the rebranding of some of these large luxury items and brands. Jaguar is one Matt and I had covered a little earlier this year. That's a pretty extreme example, but there are others as well. How much of this is just customer taste changing and the companies needing to react to those changing preferences?
There are more and more reports coming out because we also need to think about the recycle industry too. If we step back into the China situation, one of the big categories would be watches, and watches are higher indexed in China. So that's been a drag for many companies because most of them will have watches, even though jewelry has really stood up well. So that's one side of the equation. If we think about other sides,